Hi guys, so today I wanted to do a slightly different video and take you through my top 3 performing investments. So essentially the 3 stocks that have seen the biggest gains for me over the last year or so. I spent a lot of time recently updating this new investment tracker that I've started using, which essentially brings together all of my investments into one place because, as you know, I use multiple investment platforms, so sometimes it's hard to track the overall performance of my portfolio. So yeah, this tracker has been great for that, and if you want to check it out, it is in my link down below so that you can see it. It's not mine, but I will leave a link to it if you want to buy it. Anyway, this might end up being a bit of a long video, so I'm just gonna jump straight into it and take you through the top 3 performing stocks for me over the last year. So the first one I'm going to talk about is Greggs. I have had a 68.5% return on Greggs, which is just absolutely crazy. Now, considering the majority of my audience is UK based, I don't think I need to explain what Greggs is, but just for those of you who aren't, Greggs is a British bakery chain and it specialises in savoury products such as bakes, sausage rolls, sandwiches and sweet items like donuts, etc. It's actually a constituent of the FTSE 250 and it was founded 82 years ago. Now, I've been talking about Greggs pretty much since I started my channel because it was one of my first investments, and I said that it was one of those that I invested into purely out of how much I loved the company and how much I supported them and thought that they had a great future. Obviously, I don't recommend, investing into things before reviewing them or doing your analysis, but for me, Greggs was that at the time, and I was very clear about that. I didn't pretend otherwise. So the fact that it's done so well, it's just crazy to see. Unfortunately, I do only have 3 shares in them, which is really sad. I do wish I'd invested more, which means that my almost 70% gain is only 36.92 in terms of pounds. But let's have a look at what the platforms are saying. So if we have a look at tip ranks, we can see that Greggs is actually forecast to outperform the S&P 500, which, if it continues with these kinds of gains, it definitely would. If we have a look at the stock charts, it is currently at its all-time high, which is not surprising. They are doing really well with their vegan range, etc. And in terms of analyst ratings, we've got 4 buy ratings and 1 sell rating in the last 3 months. It does seem like the low rating, i.e. this one person who's given it a sell rating, is dragging down the potential up or downside. So maybe despite the buy ratings, the analysts are being quite conservative with their price targets. Okay, so let's have a look at what Genuine Impact is saying. If we filter it on the consumer discretionary sector, which is where it lies, we can see here that maybe it's not doing so well on their ratings. Out of 950 stocks on here, the momentum is doing really well. It's number 74. But in terms of value and quality, they are sort of around the mid 600s. If we look at the checklist, it does seem like the only things they are in the bottom 20% for out of consumer discretionary is historical growth, which makes sense, and expected return, which doesn't make as much sense. But they are in the top 20% for momentum, ESG, ESG, which is really, really important these days, historical returns, and expected growth. If we look at its performance, we can see here that it's actually doing really, really well compared to the US stock markets and the global stock markets. So 3 months, a year, 3 years, 5 years, and 10 years. It looks like it's consistently outperformed all of them. Madness. There's tons of data here, and obviously it would take me so long to go through it. So if you want to check it out, link to download the app and have a free premium trial is in the description, but let's just quickly have a look at 3 more things. So we've got ESG here. The rank is 58, which is really good for 950 companies, which is very high. So they do have a very good ESG rating. And for dividend strength, it is medium, and I think part of that is because they stopped their dividends as a result of last year. So we'll see what happens there, but they were pretty decent previously, I believe. Now, the final thing I want to look at here, obviously, like I said, so much data, was this area here. So they seem to have beat their revenue and earnings per share targets, both a year ago, 2 years ago, and currently. And as we can see here, the analyst ratings on here are also pretty skewed towards the buy rating. So we've got 75% say buy and 25% say hold. Now, finally, I just want to have a look at Simply Wall Street. So we can see here that they also think that earnings are forecast to grow 6.5% per year, and the earnings grew a lot over the past year. They do, however, seem to think that Greggs is overvalued currently by a hefty amount, so 53%. Although it does look like their dividends are back, so it will be interesting to see whether I get the dividend or not. But this, according to this, it does say that if I buy in the next 14 days, I will receive a dividend. So watch this space. We'll see if it comes up in my next dividend updates. But yeah, that's that. So that's Greggs as the first thing to discuss. The next one out of my best performing stocks is American Express. So I've had a gain of 50.5% on my Amex shares, which is, again, pretty crazy. And if you don't know what Amex do, they are a multinational financial services corporation. They were founded 171 years ago and are one of the 30 components of the Dow Jones Industrial Average. So they are a financial services company, but they are obviously most well known for their credit cards. I have two. I have my personal Amex and my business Amex, and honestly, the points I get are insane. From setting up my business credit card with them and getting the bonus for the sign up, I've got so many air miles that I might essentially be able to get a business class flight for almost free, which is crazy. Or I could get pretty much 2 return flights to Dubai for free, which is insane. But anyway, let's have a look at Amex. So Amex is also forecast to outperform the S&P 500, and they are almost near their all-time high. So they have dropped a little bit currently. They also hold a moderate buy rating currently, according to these analysts. So 8 say buy, 9 say hold, and 2 say sell, which is crazy. But the average of the price targets shows an 8% potential upside. If we filter just on top analysts, however, it actually doesn't change very much. So still 8 buy, 7 hold, and 2 sell. Now, if we look at Simply Wall Street, we can see here that they are forecast to grow 6.4% per year in terms of earnings, but they have a high level of debt as a risk. They also have a 1% dividend yield, which isn't great, but better than nothing. And in terms of valuation, it seems like they are right on track at the moment. Okay, so let's see what Genuine Impact say. So again, let's filter on financials because that's the sector they are in. And we can see here that, again, it doesn't seem to be looking too amazing in comparison, except on the momentum where it's doing not too badly. It seems to fail on value, but be top on momentum, ESG again, liquidity, size, and accounting strength. We can see here that generally it's not always outperforming, but not hugely underperforming either for all of these. So the last 3 months, it has underperformed those stock markets. In the last year, it has outperformed. So kind of hit and miss, but like I said, I've gone up like 50% on it, which is crazy. Again, there's tons of data here, so we won't go through everything, but just to have a look, like I said, ESG and dividend strength are both high, and let's have a look at these analyst ratings. So analyst ratings are again quite mixed. So this seems to be a controversial one. But 43% today and 50% in the last 30 days have said that it's a buy, and then about half of them have said hold. They do seem to consistently miss their revenue targets, but beat their earnings per share. Do with that what you will. Now, the final one that I wanted to talk about is Cincinnati Financial, and I've probably said that wrong and all the Americans are going to laugh at me, but it's fine. So I've made 57.38% in total on this investment. As you can see, this one is in stake, in the stake app. So again, all my free share links, etc., are down below. Cincinnati Financial is actually an insurance company. So they offer property and casualty insurance. They have 1% of the domestic property and casualty insurance premiums, which rank it as the 20th largest insurance company by market share in the US. It was founded in 1950, so it has been around for about 70 years, which is always a good sign also. So 20th largest in the US by market share is crazy. Insurance is a massive business. So it's really good that it's done so well for me. If we look here, Cincinnati is showing as a strong buy of 4 ratings. So 3 say buy, 1 say hold. The average upside is showing as 6.5% currently. And once again, they are forecast to continue outperforming the S&P 500. This is interesting though, because on Simply Wall Street, we are saying that they are trading at 29% below the estimate of fair value. Their earnings grew by 400% over the past year. They pay a reliable dividend of 2%, but for some reason, their earnings are forecast to decline by an average of 40% per year for the next 3 years, which is quite interesting. So once again, let's look at genuine impact and filter it by financials. So they do seem to be doing better here than the other two did. Quality 179 and momentum 55. So there is quite a lot of momentum going on with them at the moment. They don't fail in any of these, and they are top in quality, momentum, liquidity, size, and accounting strength. Again, this one is pretty similar to Amex, where mostly beating the stock markets, but not always. This is interesting though, because on here, most of the analysts are actually saying it's currently a hold rather than a buy. So quite different from what the others were saying, which just shows you that you need to do a lot of research on your own before you come to a conclusion on what to invest. Let me know what you think of these 3 stocks, and thank you to Genuine Impact for sponsoring the video. If you don't know what they are, you would have seen me just now going through them. They are an app where you can get a lot of data about stocks and shares. It is generally a paid for service, but you can get a free trial of premium, and you do have a free version of the app, I believe, as well. So check the link out, sign up, see what you think. And yeah, that's it for today. And thank you. See you next time. Bye.